there. So I'm just checking here on our attendees, and I hope is everyone is available today so that they can attend our webinar for today. And for those of you who might be viewing this as a recording, just for your information, if this is your first time knowing about this webinar with Max and Martin, this is actually our week 3. So for those of you who are in the room right now, and most probably you missed the week 1 and 2 of Max and Martin's webinar with Real Estate IQ, please let me know through email. So let me just post my email address in the chat box, iq.co. So there. So don't worry, it's not a typographical error. It's not really .com. That's only co. So if ever you missed week 1 and week 2 of our webinar with Max and Martin, master the art of maximizing profits from the real estate investing experts. Please let me know in the email so that I can send you a copy of the recording, so that you can follow up and you can be updated of the topics from our week 1 and week 2. So for those of you who are in the room right now, welcome everyone to our week 3. So I just checked my calendar, and I think this is the last webinar of this series. And I've been with Max and Martin with their previous webinars, and it really, really is a very informative webinar with Max and Martin, as usual, of Express Capital Financing. So you're lucky that you're here today, and you'll be witnessing the week 3 of our webinar with the topic commercial financing. So again, if ever you missed the previous webinars, please let me know in the email through email so that I can send you a copy of the recording and you can be updated. And right after this webinar, just most probably 4 to 5 hours, we're just waiting for Zoom to finish the updating of the recording of this webinar. We are sending emails to all of our attendees so that you can have a copy of today's webinar, in case that you can review, and you can go back to the whole series if in case that you wanted to master the topics with Max and Martin. So, and I know that most of you and all of you are now masters of Zoom. So most probably we don't need to give you like a walkthrough on how to use our tools. But if in any case that you still are confused with how to use Zoom, please let me know as well in the chat box. So while Max and Martin are discussing, I can help you out with any technical difficulties with your Zoom account or during the webinar. So just let me know in the chat box so I can help you out. And throughout our webinar, we'll be launching polls. So in our polls, we have a total of 5 polls during this webinar. So if you answer all of the polls, and the first poll is up right now, you can be eligible to join our raffle. So just by answering the polls, we can get your names, and we are doing a raffle every week, and we are announcing the winners every Monday. So our customer service team are contacting you. So please make sure to have your lines open and always check your inbox within the week every Mondays if you are the lucky winner of the week. So thank you so much, Eric, for posting your contact details, and for the others, you can also post your contact details, your email address, in any case that you might want to do some networking to connect with others. And if ever you need help with your business, you can also post your contact details so that some of our investors in the webinar or our attendees can help you out if ever that's the nature of their business. So Martin just told me that we have another webinar for next month. So for those of you who will be interested to attend Max and Martin's webinar with Real Estate IQ by the following month, make sure to just go to realestateiq.co/events so that you can be updated of our upcoming webinars with Max and Martin. So also we have a poll, on a fourth poll on our webinar today, that gives you an update weekly or daily for our event. So what is that, Martin?
No, it was Max. So just really quickly, I wanted to tell you that we were not the webinar. We didn't schedule the next one yet, but we're going to be at the Real Estate IQ event that they're hosting, where there's going to be multiple people speaking. Itself. So we'd love to see everyone there. I think it was on I want to say the 15th. I could be wrong though.
If I'm not mistaken, let me just check the calendar, but I think it's not yet on our calendar. But yeah, it is. I think there's some good news if you are aware from our attendees. we had those monthly webinars with some good news. So Max and Martin will be there. So I hope everyone are available by December, because we'll be posting them in the website as well, in realestateiq.co/events. So make sure to register for that. And I guarantee you that, every some good news event is really, really juicy. You will learn a lot from our guest speakers. So just a very quick agenda for today. We're just doing some networking, some welcoming right now. So just to give time for our attendees to connect with each other, wait for other attendees that might be late for our webinar for today. And around 10 minutes, we'll be discussing commercial financing with Max and Martin. So make sure to have your pens and paper ready. Or if you're quite hungry, have a cup of coffee, or be ready for your meal today, so that you can focus on the discussion with Max and Martin. And around 7:15, we'll be doing a Q&A. So everyone, you can post your questions in the chat box, because Max and Martin can see them, so that even if, before they miss your questions, they can actually check on the chat box from time to time, so they can answer your questions, just to make sure that before we end the webinar, all of your questions will be answered. And this event is brought to you by Real Estate IQ, the number one in deal finding, providing you with more than 45,000 leads every month. So for those of you who are new to Real Estate IQ, let me just play a very quick testimonial from one of our clients with Real Estate IQ, just to give you a background on their experience about our tools. So let me play the video for you.
When did you start using Real Estate IQ?
I'm going to say probably less than about a month ago, and we actually had a lot of success. It's a great list. We recommend it for everybody. We got actually a deal in the first month using it, and with all these new features that are coming on it, and we're signed up for it, we just can't wait to make a lot more deals. So we're excited. Great list, guys. Trust me, I recommend it. Worth every penny.
Yes, we heard about it, had to jump on it real quick.
And it's amazing. It's been amazing for us and our family, and it's produced revenue for us and a better way for us to live. So we appreciate it. Great work. And it's a great product for everybody. We definitely recommend it.
Yes.
That's beautiful. We're very happy for you guys. When did you start using?
So there you have it. So that's one of our clients with Real Estate IQs using our tools. So for those of you who are not yet a subscriber with Real Estate IQ, or you don't have any ideas about our tools or our system, make sure to answer this poll on your screen right now. So this is for our one-on-one deal finding training. So our team can give you a very quick background of our tools and how to use them, or how can we even help you improve your business. So make sure to answer this poll on your screen, so we can schedule you for this one-on-one deal finding training. And for those of you who are already a subscriber with Real Estate IQ, we invite you to join our webinar, our deal finding webinars with Becky and Rodney, so that they can give you a walkthrough on how to use our tools, how to master our system, and it can definitely help your business grow in the future. So there, I skipped it. So I will now introduce to you our speakers for today, Max and Martin. So again, this is the third week of their series with us for this month, and it is my pleasure to host, as always, their webinars with Max and Martin. So it is a very, very informative journey for me, because I'm learning a lot from Max and Martin, even in the few months that I have hosted their webinar. So let me give the floor now to Max and Martin.
Thank you so
Hello,
much.
everyone. How you say, Max? Hello.
How's everybody doing tonight?
So, hello, everyone. Martin Chera here from Express Capital Financing. I happen to be the owner of the company. We're a father and a two-son team out in New York City. What we do is we specialize in all types of real estate financing, whether you're looking to buy a commercial property, a fix and a flip, a buy and hold. We do it all except a primary home. We're here to engage everybody, to explain how everything works, the process, debt service. We're going to go through a lot of information. One thing I do want to say is, please speak to your tax attorneys, your consultant, your CPA for any type of advice. This is only for informative information only. So we're going to be explaining how a commercial finance loan works. So everybody enjoy the show. Hope everybody is safe. Hope everybody is sound and safe. Anybody, unfortunately, that, has any situations from this COVID, our prayers are with everyone there. So now we'll begin the webinar. So what is I'm going to say financing? It's always about using other people's money, whether you're going to a bank or a private lender. The more money you get, which is leverage, the more returns on your investment is. When you're using your own cash, you're maximizing your risk, you're minimizing your return on the investment. And all types of real estate, it's about the cap rate. And most importantly, it's about the profits, which is, your return on the investment. So always using somebody else's capital, whether, again, it's a private lender or a bank, is not only safer, but it minimizes your risk and it minimizes your deposit. So we're going to go through some topics tonight, which is what is a commercial real estate financing? And another word for that is CRE, commercial real estate. How a commercial real estate loan works, types of CRE loans, what do lenders look for, how to prepare for the application process, where to get a CRE loan, calculating what lenders look for, which is what's called debt service coverage ratio, and what is a return on the investment. Now, please, folks, don't confuse, by the way, with the CRE with 1 to 4s, whether it's, on a single family up to 4 units, that's not considered a commercial property. So single family duplex, triplex, quadplex is a different, it's a little bit the same, but a lot different also. So what is a commercial? Give me 1 second. I'm sorry. So what's a commercial loan? It's secured by a lien on the property as opposed to a residential property. And that's why I'm saying CRE is it's a different realm than a single family home. So we refer it to an income producing real estate property that is owned for business purposes. Office, retail, hotels, apartment, mixed use, shopping centers, and ever so much today, storage facilities and warehouses. That's commercial. That's what's considered a commercial real estate financing. CRE loans are generally made to investors, corporation, developers, landlords, partnerships, funds, and something that's called a REIT, which is a real estate investment trust, for the specific purpose of owning and operating a commercial real estate property. The business entity that purchases the property, leases it out, and then collects rent. Everybody's in it for the return on the investment and for the cash flow. The financing for this venture, including the purchase, the development, and possible construction of the property, is accomplished through a commercial real estate loan. And that typically is going to be what's called a hard money or bridge money when we're talking about development or construction. So we're going to go through different topics here, different phases, so everybody understands.
And just to add in, by the way, anyone that is interested in 1 to 4 units, if that is your primary focus, you could check out our last webinar that we did about the Rental 360.
Great. Okay. So commercial real estate loans, what do they typically are? So investors can take a low of 5-year fixed terms up to 20-year terms. And the amortization period is often longer than the term. So what do I mean? Typically, the terms of a fixed rate are 5, 7, 10, but you always want the longest amortization. Just like a car lease, the same car, you take it out for 12 months, you're going to have a higher payment. When you take it out for 48 months or 60 months or 72 months, you're going to have a lower payment on the same car. So whenever you're taking a real estate loan or real estate transaction, you believe it or not, you always want the longest amortization possible. So the monthly payments are determined as if the loan was being paid over 30 years. Lenders consider the nature of the collateral. Typically, what the purchase price is going to be, the credit worthiness of the borrower, the experience of the entity, which in this case happens to be the principal or the borrower. Now, when I say experience, you want to buy a large multifamily and a few $1 million, and you want to go to a bank, your credit could be great, your tax returns could be great, but they do want to see experience of bank. And we're going to get through the different facets of a loan program, where is better to go for your specific needs and goals and strategies. but banks definitely want to see experienced borrowers. So not, you could have great credit, you could have all the liquidity in the world, but they definitely want to see a borrower that has the capacity to manage the property, which is very important to know. Also, again, including 1 or 2 years of financial statements, possible income tax returns, and the financial ratios, such as the loan to value and the debt service coverage ratio when evaluating a commercial real estate loan. Down payments typically are in the range of 20 to 30%. Whether you go with any lender, hard money, bank, non-bank, traditional, non-traditional, right now in these days, mid-COVID, on a commercial real estate, you are looking 20 to 30%. And even 20% down is very rare. We could do it with our non-bank permanent financing, which I'll get to in a little bit. But most common today is about 25 or 30%. And interest rates typically range from a bank, 3.5% or above, which we'll get to in a little bit. Loans are backed up by small business if you want to go a small business loan, which are the cheapest, somewhere between 5.5% to 7%, depending on the size and the length of the loan. So, types of commercial real estate financing. So permanent loans, they're fixed mortgages, like I said before, commercial property. It's fixed from anywhere, like I said, 5, 7, or 10. But the amortization can be or will be 20, 25, or 30. If you're looking for the lowest rate and the highest, the lower monthly payment where your cash flow is higher, keep in mind you want to always go with that 30-year AM. What's the difference between a 5, 7, or 10? It's going to be the rate. The longer you're in that term fixed period of 5, 7, or 10, the higher the rate will be. But keep in mind, again, sometimes the rate is not always important, because if a bank is giving you 3%, but a non-bank is giving you 6%, but a bank is giving you 20-year and a non-bank is giving you 30-year, most likely that payment will be lower and your cash flow is high with that non-bank because of the amortization. So it really just depends. Second way of going, of course, was with an SBA. It's written sometimes traditional, non-traditional lenders, and they're guaranteed by the government, which is Small Business Administration. There are several different SBA loans that cater to different types of borrowers, and the most popular is a 7A. For all intents and purposes, I do want to clarify, an SBA is not meant for investment properties. I want to be clear. SBA is not meant for investment properties only. It is owner-occupied. And I don't mean owner-occupied multifamily. You can't live in that property. SBA is only meant for commercial properties, a shopping center, a retail store, a mixed use that you're operating downstairs on the retail, a bowling alley, a golf course, any type of business that you want to operate and own that property, that is only for that can be for SBA. But there are a lot of investors that think, oh, I'm going to get an SBA and I want to just be the landlord. Not meant for that. Not meant for that. So bridge loan provides a short-term mortgage on a commercial property, typically anywhere from 6 months to 3 years. Bridge loans are typically obtained when a borrower is waiting for long-term financing and attempting to get a refi on an existing obligation, which I'll explain in a minute, but they're meant more for Taylor when the properties are empty and require capital improvements. Once the properties are fully rented, another word for it is stabilized, the borrowers can go to a bank or a non-bank such as Express Capital. So before Max, you go to the next page. So why is a bridge loan, is needed for the borrower? A bank and even a non-bank is not going to lend on a property that's empty. You got a multifamily that's half empty, all empty, 60% empty. No bank or not bank is going to touch it. So I want to keep in mind, folks, that when you're using a bridge loan, it's meant when properties are not stabilized, meaning they're quite empty or fully empty. It needs capital for, we call it rehab or CapEx. And then you, as the investor, you want to get it fully stabilized. You want to get it to a nice projected rent. That's what a bridge loan is meant for. So it's short term, providing you high leverage on the deposit, on the purchase. It's providing you with 100% of the CapEx, or in this case, rehab money, to get the property fully rented and stabilized, and of course, cash flowing. So what do lenders look for? So what lenders look at to calculate the company's debt service, when we say company, we mean the deal, the debt service coverage ratio, which is defined as your annual net operating income divided by the annual debt service. A ratio of 1.25 or greater is typical requirement. And I'm going to go into that in right now. Assuming you have a property that's flowing gross cash flow $100,000 and $50,000 is taxes, expenses, maintenance, property manager, so forth. You're left with a $50,000 NOI. That is your net operating income. Don't look at it as 100 because after expenses, you're netting 50. So that is your net operating of 50,000. Then we take what that possible debt will be. Let's assume the debt, principal and interest, will be $30,000. So if you do 50 over 30, you're coming up with 1.20. Basically, 20% is left, or $20,000 in this case is left. Most lenders want a 1.25 or greater. We can work with 1.20 on some deals. So it's important to know also not just about the rate, not just about the fixed terms, and not just about the amortization, but what lender wants the lease debt ratio. Typical today, bank, non-bank is a 1.25, but there are some non-bank lenders such as us that can work with the 1.20. And again, this is for permanent financing only, not for bridge. So if your business is debt-free, again, it means the property, and you're applying for $100,000, the lender will want to see that you're bringing in a net operating income of 125, so we can give a loan out of $100,000. So to take 125 over 100, you're left with a 1.25. A lender also checks credit score, possibly background checks. They want to make sure that the borrowers are, no bankruptcy, no tax liens, no tax liens, judgments, bankruptcies, foreclosures, nothing like that whatsoever. They're looking to make sure that there's no mortgage payment history lates, but a non-bank will be much more flexible, which we're going to go through very soon. Banks are very tedious with the process, where a non-bank is not. So, personal finances. Small companies, and again, when I say companies, I mean borrowers, they're usually controlled by an owner or a few partners. By the way, a good thing to know is when it comes to CRE, you cannot do the loan under your personal name. So most banks, non-banks, hard money lenders, they want an entity for many, many reasons, which I don't want to get into now. So if you're looking to go into contract, make sure that you're going into with an entity. It's important to know. I will say with us as a non-bank, certain states, we could do it if it's individually owned or being acquired. But banks, I'm almost positive they want it owned under an entity. So banks and commercial lenders will want to check your personal credit, the history to see if you have any financial problems in the past. Like I mentioned, any defaults, foreclosures, tax liens, judgments, bankruptcies, foreclosures. Low credit score could harm you as an individual or the borrower's chance of approval with a commercial loan. However, a non-bank, again, such as us and other non-bank lenders, we're not credit sensitive. Why do I say that? We deal with borrowers in the 500 scores, 550 scores. So even though we're going to look at the credit and the background, we're just going to charge a higher interest rate. We want to hear the story, and that's very important. An executive summary, some type of a simple story. One of my borrowers, unfortunately, he saw his child this happened a few years ago, his child run across the street and got killed. And his wife took care of all the paperwork, and she was, depressed in her bedroom for 2 years, didn't pay any bills. So his credit went from a 700 plus to a 500 plus. So we understood the story, and we were able to, get comfortable and provide him with the financing. So when you have a story behind it, we call that a letter of an explanation. We'll work with you. A non-bank lender seeks to ensure that the property is debt servicing a loan. Why do I say a loan? Because again, a bank is going to look at your credit, your background. We call it global debt service. They're looking at your tax returns, your income, your W-2s. Where a non-bank, we're just making sure that the property can cover the debt. That's it, simply. Of course, we're looking at credit and background, but again, we can work around that, or a non-bank will work around that. So we're not credit driven. No financials are required, like I mentioned. No W-2s, no tax returns, no income verification. What does a non-bank look for? it depends if it's occupied, non-occupied, but most importantly, which I'm going to talk about in a few pages, is going to be the rent roll and the income and the expenses. So it's a much quicker and an easier, streamlined process. So property characteristics. Again, this is strictly for commercial properties, and this is just a basic. There are more different types of commercial properties, but I'm just giving you the typical everyday type of deals. Multifamily, and when a lender says a multifamily, it means 5+. So investors, if you're saying the word multifamily, please keep in mind when you're talking to a lender, it's 5+. Retail, mixed use, shopping center, and office buildings, industrial, warehouse, self-storage, by the way, very, very popular today, especially during COVID. A lot of landlords and tenants are utilizing self-storage, so the growth is very great. Skilled and assisted living, daycare, memory care are very good property characteristics. Loan to value, always a lender wants the investor to have skin in the game. Today, right now, 70, 75% can happen, definitely could happen. So that's good to know that you're going to be putting down 20 or 25%. So for example, if the property you're buying it for 200,000 and the lender acquires you, they're going to finance you 70%, 7 times 2 is 140,000 will be the loan amount, and $60,000 you'll have to come up with cash equity into the deal. I know some borrowers may ask a question, oh, how about a seller's concession, seller's kickback? With a bank, I don't think it's ever going to happen. With us and other non-bank lenders, we could talk about it, seller's concession or seller's kickback, maybe 5 or 10%. That's where a non-bank comes in a little more flexible as far as credit, less paperwork, streamlined process. Maybe you got a seller kickback. And again, that's where a non-bank has the pros. What is hard money? So hard money, like I said before, is providing high leverage, low deposit, low risk. You can also get hard money for the CapEx, or we call for the rehab, to get it stabilized, to get it fixed up, so you can have a cash flow and then go into permanent if you want to keep the property or sell it to an investor at a greater cap rate, or should say a cap rate, because now you got it cash flowing. So what are we doing? We're concentrating on the current and the projected value of the property for fewer requirements other than financial disclosures. So if you're buying a mixed use property for 200 grand, we're looking at the current property value, and we're going to be looking at the projected value. We call that after repair value, or the stabilized after repair value. We're looking at both scenarios for you. And why? Because we're going to max out at an ARV of typically on a commercial property, believe it or not, 70 to 75%. So even though we're loaning you 70% or 75 of the 200,000 as an example, assuming your after repair value is going to be $300,000 or $400,000, we can cap it out at up to 70 to 75% of that as well too. So in general, banks and lenders will require you to meet the following qualifications: projected cash flows for the life of the loan. And as a hard money lender, what are we looking at? Again, projected income, projected rent roll, projected income and expenses. And that's why we call it pro forma. Or if it's a little bit cash flowing or all cash flowing, it's going to be actual. So you may say, well, why would a hard money lender lend if we have actual cash flow? Maybe you have maybe you need $100,000 or $200,000 in repair money. Maybe you got $100,000 HVAC unit that you need to be repaired, and you need quick turnaround money to get it done, fix it so you can keep your tenants. Maybe due to COVID, you got a 50%, vacancy rate. They left for whatever reason. And now is the perfect time where you want to fix it up. And a bank is not going to lend you when you're at a 50% or less, or even 80% or less stabilized. A lot of my borrowers are coming to me and saying, hey, I got a 50% vacancy rate or 50% occupancy, and I want to fix up my multifamily. Can I get some hard money? And I'm saying, yeah. So this is where it comes in good for the hard money. The credit reports on all borrowers, again, hard money lenders are typically not credit driven. We're just looking to see if there's any skeletons in the closet on a background check or something like that. Your state certificate as a corporation or limited liability. What does that mean? We want to make sure that your corporation is what we call a good standing certificate. Max, am I saying the right word?
Yeah, certificate
Good
of good standing.
certificate standing, right? So it's not like it's 3 years old, 4 years old, and it's dormant, and the state has no idea if it's dormant or live. So typically, all hard money lenders want to make sure that your entity has a good standing certificate. We can order it for you. You could check it up on Google and see if your company is live, or you just pay $95 a year to keep it live and something like that. Lenders, hard money lenders, we're going to look for appraisals on the property. Some of my investors say, hey, I don't want to get an appraisal. I can't get an appraisal. Hard money lenders, when they're lending you millions of dollars, they're not just looking to protect ourselves, we're looking to protect you. So the appraisal is going to have the actual value of the property. And don't forget, it's going to have that after stabilized repair value. So it's very important, not just for us as your lender, but for you, so you can make a profitable, informed decision. Now you may ask, well, can I use another appraisal from another lender? I did it myself. Call us. We'll talk to you. It's not, how do I say the word? We don't like it, but we'll talk. We'll see what we can do. A business plan that explains how the property will be used, as well as an explanation of the company or / borrowers having a management of the property. We call that a personal resume, or the borrower's resume. We want to know that, the borrower has done, I'm not going to say the word 3 flips, but because now we're talking about commercial properties. The borrower has, 3 multifamilies in Texas. He bought them for this amount of dollars. He bought them in 2718. He brought them up to this amount. Either he owns them, sold them, did this, did that. A little, 1-page resume on the borrower, just to get a good feel and comfortable with a hard money lender. Okay, how to prepare for the application process. So a non-bank lender, and folks, what do I mean by a bank and a non-bank? So a non-bank lender, like I said, is going to give you more flexibility with amortization, a lot less closing costs, a lot less closing time, streamlined process. And a non-bank lender such as us, it's a much easier communication, a lot less red tape and communication, because we are the lender, to get your deals done. So we concentrate on, like I said before, the current status of the property and the debt service. So we're not asking for the borrower's tax returns, W-2s, and income verification. We're not doing a global debt service on the property and the borrower. We're just doing strictly to make sure that the property itself can debt service on a non-bank permanent financing. So a non-bank lender is going to require you to meet the following qualifications. So 2 years tax returns, we put in there case by case, because if you're able to provide it, we're probably able to get you a better rate. You don't have to give it to us. You don't have to give it to your non-bank lender, but it would make the lender feel comfortable if they could see it. If not, no worries. We got borrowers have losses, profits. They just don't want to show it. So if you don't want to show it, you don't feel comfortable, that's where a non-bank lender comes in. I will tell you, I will repeat again, a bank is definitely going to require your tax returns, 2 years, profit and loss, your W-2s. They're going to ask for your life. And by the way, banks are taking a personal guarantee on your loans without a full guarantee. We call that full recourse. With the non-bank, such as us, we're gonna ask for a guarantee on the entity, but it's called a warm body guarantee with bad boy carve-outs. And what that means is, if there's fraud, if you took a second lien on the property, or there's, you filed bankruptcy, that's a bad boy. Other than that, a non-bank lender, we're just taking back the property. Where a bank, they're taking the property and they're going to get every dollar that's owed to them, plus, unfortunately, any private assets that you have, because you have a personal guarantee. So with a non-bank lender, you're going to have a personal guarantee on the entity, but with warm body carve-outs. As long as there's no fraud, no bankruptcies, no second liens, none of that nature, we're not going after the individual. We're just going after the property, so we can recuperate our loan. So third bullet says the credit reports for all the borrowers and partners. Again, the state certificate to make sure that it's a good standing corporation, third-party appraisal reports. And by the way, for the folks out there, yes, your lender has to order the appraisal. We have to order it. Again, bank, non-bank, hard money, what lender you go to, they have to order it. It has to be in their name for a lot of legal reasons, guidelines, insurance reasons. and things like that nature. So if you have an existing one from another lender, we could look at it, but we're not going to be able to use it. No bank will even look at it or touch it. So a business plan that explains, again, how the property is going to be using, so we could have a resume on the borrower.
Just a slight correction. So if another lender did order the appraisal, that is fine. We can get that transferred to us. If the borrower orders the appraisal, that's when we cannot use it under any circumstance.
So Max, I'm sorry to correct you publicly, but no, commercial on mortgage financing, we have to have a new
Got it.
A new appraisal.
Got it.
So that's 100%. So okay, so where do you go now to get commercial real estate financing or loans? Okay, banks. What's the pros? Yeah, they're going to give you a good rate, 3, 4, maybe 5%. Possible synergies with other accounts. What do I mean? You maybe have your banking relationships, or so they're going to give you better service, a better rate, possibly. But the opposite also could happen too. If you're going to go to a bank to get financing, they're going to want your business banking and your personal banking. Are you willing to give up all your accounts just to go with that bank that's giving you possibly a 3-4%? So you got to look at all the goals, strategies, and the needs to make sure that you're doing the right thing. Because I've had investors who just hear 3 or 4% and they run. I mean, the banks say, I want your life, I want your business banking, I want your personal banking, I want your wife's banking accounts. It's a hassle if you want to do it. And again, if you remember what I said, folks, shortest amortizations available. Banks are typically 15 to 20 to 25. Yes, there are banks that give 30, no doubt about it. Yes, but most of them typically are 15 to 20 or 25. What's the negatives on it, the cons? Well, they're going to ask you for a lot of documents, W-2s, tax returns, like I said, and a slow process. What's a slow process? Believe it or not, I had one of my borrowers who it took him about 2 months just to get a term sheet out. With a non-bank like us or any other non-bank, you could probably get it the same day or 48 hours because we're fully underwriting, we're fully doing everything. We're prepared to move quickly. Only the borrowers with good or excellent credit. I believe, I'm not sure that banks today want 680 plus. I'm not too sure about that, but that's what I believe. With us as a non-bank, we can work with borrowers 550 or above. Where to get commercial financing from? So, okay. So in non-bank companies that provide CRE loans and to mid-sized companies or small companies, less rigid underwriting standards, faster approval and closing time than the banks. And I'm happy to say, folks, we can close your permanent financing in 3 to 4 weeks. And I repeat the words permanent. So if you got that commercial property, it's already stabilized, it's already rented. This is for permanent lending, a non-bank, 3 to 4 weeks close, get you a term sheet out within 48 hours, no worries. Lower fees and a lot less closing costs than a bank. Longer amortization. If you remember what I told you, 30-year amortization. By the way, we even have 30-year fixed 30-year terms. 30-year fixed with 30-year terms. No balloon programs. So banks, when you got a 5-year fixed or 7 or 10, it's not self-amortizing. So in that 5 years, you have to pay them off. I repeat, you have to pay them off, whether it's a refinance or you sell the property. With a non-bank, it's called self-amortizing. So if you took a 5 or 7 or 10, it's after that fixed period, the rate's going to adjust. And whatever that adjustment's going to be, typically it's 1% a year, capping at 2% for the life of the loan. It could still continue their payments for the next 25 or whatever years are left. You don't have to refinance. You don't have to sell the building. So which that's important to know also. Banks, Fannie and Freddie Mac on a multifamily, 750 minimum. With a non-bank lender, 50,000 minimum. And like I said before, we could do a fixed 30-year, which is very, very rare. What's the cons? Yes, the interest rates are going to be higher. However, what is it all about? It's about your cash flow and it's about your return on the investment and your cap rate. So not always is the rate the best option. It's about your amortization. Amortization will increase your cash flow and also it will increase your cap rate. So like I mentioned before, you can, and folks, you can if you're occupying the commercial property with an SBA. So it says here, owner occupied property, like I said before, and by the way, good thing about SBA, let's assume you're buying I don't know, a mixed use, and you're going to operate the retail below on the main floor. An SBA would be good for working capital, maybe some equipment, deli equipment, refrigerators. So SBA can be good for that, whether it's working capital, equipment, and high leverage for an owner-occupied user of the commercial property. They could now, how does an SBA work? Usually, 50% of the money comes from the actual lender, which is the bank, and the other 40% comes from the government, where you're putting down 10%. If the SBA lender requires 20% down, well, that 40% becomes 30% from the government. So it's more riskier from the bank because the government is providing less, how do I say the word to you? They're creating more risk for the bank, for the lender. What's the pros? You can get below interest markets rates, but right now they're between, because I'm also an SBA preferred lender, you can get rates right now, I'm going to say, in the mid-5 to the mid-7%. So it's not much different than a bank, believe it or not. And even us, it's not so much different. The good thing about it with an SBA loan is you're going to get a higher loan to value, and you will get working capital or equipment financing as well. What's the cons? 10 to 20-year terms. 10 to 20-year terms, only available after you exhausted all your alternatives. Folks, some guys, some investors, some landlords, I say investors and landlords, they want to go the SBA because they think they're getting the greatest rate. It's not so much so. And just like a bank, they're going to be asking for personal guarantees, and because I did one myself years ago, they are going to put your primary house as a guarantee also, and your life insurance policies as a guarantee on your loans. So are you willing to put up your life insurance for your family? Are you willing to put up your primary home? These are, some things to think about. That's why I mentioned public policy restrictions on eligibility, slow funding process. It's a minimum of 2 months, a minimum of 60 days. The advantages, I just want to go over it again. You will get high leverage, and you can get, like I said, working capital or any type of equipment in your business. Okay. So you can borrow up to $5 million through a lender, depending on your company's size. But I say company size, really more of the loan, the loan size and the deal size. They could be used. Oh, great. One of the advantages, SBA will lend you if you're building a facility. And again, it could be for your own business, a storage facility, a mixed use, shopping center that you're going to be occupying yourself. An SBA lender can provide you with the construction, and then they'll put you into permanent themselves. They call it like a bridge to perm type of a structure. The rates are based on the Wall Street prime rates, but again, the rates are somewhere between 5 and 7%. What's the pros? You're going to get below interest market rates, 25-year terms. The most loans are fully amortized. So what does that mean? So when it comes to an SBA, and you're getting, so it depends on the loan size, but if you remember what I said before, in a non-bank or a bank, you're getting 5 or 7 or 10 fixed, and then it either self-amortize or balloons. So with an SBA, if they're giving you 25 years, it's going to be fixed 25 years. So that's a good, well, if you're using it for the business, it will be either 15 or 25 years fixed, depending on, what a debt service is for. So that's a good thing to know also. What's the cons? So limits on the company's experience. When I say company, again, folks, I really mean individuals. So if you're looking to open up a Subway shop, a Subway franchise, a Dunkin' Donuts franchise, by the way, they love franchises, whether they're new or existing. But, if you're going to be brand new and you want to open up, like I got a guy that wanted to buy an existing cleaning service business, and he had no experience. He's not going to be qualified for the SBA because SBA wants experienced borrowers running that business. So if you want to buy a commercial property that's a pizza shop and you never ran a pizza shop, you're not going to get qualified. You have to, believe it or not, show that you've owned one or you managed one, and they want to see proof of you managed one. So that's important to know also with an SBA. Of course, they want to see good credit score. I believe today it's 650. I'm not too sure about that. And it is a long approval time of 60 plus days. Okay, so hard money for commercial property. So if you remember, folks, what I said, it's more based, it's all it is based on the property value, current value, and the after repair value. These loans are usually made by private companies or private lenders and tend to have a higher down payment requirement. Qualifying for the loan is easier, and getting the loans tend to be faster than a traditional mortgage. Why would you take hard money? Time sensitive. You need to close quickly. Credit sensitive. Again, the property is not either it's zero occupancy or less than 80% occupied. You're going to need hard money. And most importantly, CapEx or rehab, that's where you're definitely going to need hard money. There isn't a lender for mortgage permanent financing that's going to lend you for CapEx or rehab unless you're going SBA if you're going to occupy the property yourself. What's the pros? Excuse me. We're not looking at credit. Well, we're looking at credit, but we're not basing you on credit. Fast approval. It says 1 or 2 week closings. That's very, very true. Like I said before, time sensitive. You got a great deal. You don't want to pass it up. That's hard money. And some folks, even if it's fully stabilized, you got a great deal for now from COVID, a lot of the uncertainty. You got some landlords, they want to dump properties and they want to close in 1 week or 2 weeks. That's hard money. And you know what? You should use hard money. You know why? Because if you need to close quick, you saved yourself a nice amount of money on the purchase because you got a good deal from the landlord or that owner. Hell yeah, use the hard money and you go to permanent whenever you're ready. So it's a great use for that. Very easy to qualify, low down payment, you're minimizing your risk and the capital needed, typically 70 to 75% loan to value. And again, let's just say your purchase price is 100 grand. A hard money lender will lend on a commercial property 70 to 75. If you're asking, can we go to 80? Will a lender hard money go to 80? If it's a multifamily, that's the best property type. We'll definitely go to 80. And like I said before, folks, we'll give you all that rehab. So if we're giving you 70 to 80 of the purchase and 100% of that rehab or slash CapEx, you're putting down very little bit. You're getting high leverage, low deposit, low risk. And, you're waiting for it to get, into permanent financing, stabilizing it or selling it. You'll be, that's what real estate investing is all about. What's the cons? High interest rates. Okay. So again, depending on your deal, I really don't want to say so much about the rates, but I will say on commercial, hard money lenders are anywhere today between 8 and 10%. And when we say 8 to 10%, it's not a month, it's 12 months. So if we take 10% a year, it's 0.80 a month. Why do I say 0.80? If you're keeping the loan out for a half a year, you paid 5%. And even if you're keeping out for a whole year, 10%, isn't it worth it to get high leverage, low deposit, low risk? But it is a higher rate, but it's short term. And that's the next, the bullet, short term. Anywhere from, depending on the deal, 12 to 24 months, sometimes 36 months if it's a large deal that you needs a lot of time to get it stabilized, to get it repaired. We had a mixed use property in Queens, New York. It took about 24 months, and we gave it. She asked for 24 months. We gave it to her. Why? I mean, also thank God because of COVID. Also, she slowed down, couldn't do any of the construction. She couldn't complete the restructuring. But besides COVID, I mean, sometimes deals just take more time than needed. So a good lender, we're either going to give you 12, 24, or 36 months. Are they going to give you 36 months flat off the bat? Probably not. As for 1% extensions, it's very common. I mean, if you think about it, we're holding a loan out. We're maximizing our risk. We're waiting to get paid. So it's something to consider, but that's what hard money is all about. And by the way, when we say hard money, it's not hard. The phrase hard money came from a hard asset. What's the hard asset? The property. So years ago, it was called bridge. What's bridge? It's a bridge to a perm. It's a bridge. It's a temporary financing until you go into permanent. After that word bridge, it became a hard money, which is the hard asset. So just to let you folks know, it's not hard at all. Okay, Max, I think you want to take over here.
Yes, I'm excited. Let's go into calculating debt service, right? So this is what we're all excited for. This is why we're all in real estate. This is why we're buying properties, because we want the cash flow. Now, we did a very similar thing for the Rental 360, but I want to point out a few differences. when we're talking about commercial properties, there are vast different types of assets, right? Like what my father said earlier, there's multifamilies, there's offices, there's strip centers, there's bowling alleys, golf courses, and so on and so forth. And there's more than I could even think of. So when we're doing this, we have to also know, hey, how are we collecting our taxes, right? So if I'm doing a strip center, I might be doing a triple net lease where I'm not paying my taxes and my tenants are paying it, and they're paying my increase. So these are all things that it's important to know. I'm not going to go ahead and really break that down too deep. It's more of just something that we want to keep in the top of our mind when we are calculating this. The formula doesn't change. We just have to make sure that we're putting the right values in the formula, right? So if you look right here, it says over here, the debt service coverage ratio is equal to our net operating income divided by our total debt service. So let's define debt service equals our payment for debt, right? So my principal, my interest payments, and I'm going to be dividing my net operating income by that number. So the things we need to know is our income, what's our rent roll, what's our expenses, what is it going to cost us to keep this property afloat. Maybe you have to add maintenance in there because you're a strip center and you have to have a guy driving around making sure that the parking lot's clean and so on and so forth. We have insurance costs. We have our principal and interest, where we can use a simple mortgage calculator to help us figure that out. And if you need to figure that out, we can have a mortgage calculator handy for us. That you wanted to say something?
Yeah, so just for the folks to remind you, if you look at the top right, net operating income, net. So if you remember before, the gross was 100,000. Let's assuming expenses, taxes, insurance, property manager, whatever utilities is 50 grand. Your net operating is 50. Now let's assume the mortgage payment, principal and interest, is going to be below that. The total debt service, let's just say it's principal and interest is 30,000 a month. Now we got a debt service of 50 divided by 30 is 1.20. So that's how we figure out debt service coverage ratio.
Yep. Let's break that down a little bit more, right? So now we have here a deal in front of us, right? Now, guys, keep in mind, I'm just using numbers here. This is not an actual deal. If you have a deal that you want to run by us, feel free to call us with it. We'll go and break it down for you, send you an Excel sheet based on all of your numbers. But let's just take this one over here where the purchase price is $250. We're getting 75% LTV. So that means that my loan amount is $187,500. Now I did a little math for you guys. I took out a mortgage calculator. I did a $187,500. What is my principal and interest at a 6% interest rate? And the number came out to $1,124.15. My taxes on this property I'm paying is $2,000 a year. And my insurance is $1,200 a year as well. So what am I collecting in rent? What am I here for? I'm collecting $1,700. So my total monthly debt, right now, my debt is equal to my principal and interest plus my monthly taxes and insurance payment. That's why it is greater than the 1124. So that total number comes out to $1,390.82. So now if I take my net operating income, which is $1,700, and I divide it by my total monthly debt of $1,390, I have a debt service coverage here of 1.22. Okay. Now you can do this annually or you could do it monthly. However, you can never do a total monthly income divided by an annual debt, right? So we just have to make sure we're being consistent. The next thing
Can I just go back one thing, Max? So I just want to, Max, go a little bit slower on that. So for folks, you look at the right side, it says monthly or annually works. So you could either take 1,700 times 12 and then take 1,390.82 times it by 12. You still get the same number, 1.22. So I just want to, clarify that for everybody out there. Now, also just to add one thing, and I'm sorry to interrupt you, Max, let's say you got income of laundry room or parking. Yeah, that's included in income. So all the income minus any expenses that the landlord, I repeat, the landlord or the investor is paying on the property. So I just want to clarify that for everybody.
Absolutely. No, it's a great point. And the key point there is that this is a ratio, right? So it's always going to be the same number as long as we're staying consistent with the numbers that we are using. So
Right.
Go ahead.
No, so if you're getting, like Maxie said before, if you're getting your tenants to pay the gas, the electric and all that, it's not an expense that you're incurring. So don't give it to us. Don't give it to your lender. It's not an expense. We want to know the property income and the property debt. We know you're always going to have a fixed expense of taxes and insurance, But if you're not telling us about utilities or something like that, then, so either disclose it so there's no surprises for you later on, but it's in your benefit if you could find a triple net lease or have your tenants pay for them. So this way you're you're decreasing your debt.
Correct. And that's also, by the way, another way that people do value add in properties that they're purchasing turnkey, right? No two investors have the same debt service on the same property because I might have higher cost. My property manager may cost me more, my whatever, right? There's different ways of bringing up my cost or expenses on a property. So just keeping that in mind, the best way to do that usually is to collect the rent roll if you're buying a turnkey property, or to create a pro forma of how you plan to build out the property so that we can help you with the debt service coverage ratio. Now, the next thing that we're going to cover is our return on investments, right? So now this is really one of the biggest tools that most investors use when they are deciding, is this deal for me or is this not for me, right? So what is my ROI? An ROI is my return on investment. How much money am I getting back for the money that I invested into this property? So it's measuring my profits in a percentage base. So to calculate the percentage of an ROI for a cash purchase, we take the net profit or the net gain on the investment divided by my cost, right? So let's actually I'm going to go ahead to the next page where it kind of breaks it down a little bit more, where you see it, right? So the gain on my investment divided by the cost of my investment equals my return on investment. Now, notice how there's a minus there by the gain on investment for the cost of the investment still, right? So I'm still minusing it from the first. Why? Because I'm not looking for the total amount of money that the deal made. I'm looking for the profit that I made. So I have to still take out what it costed me to get there, because it's not a profit, right? If it's an expense that if I made $100,000 this year, and like my father was saying a bit earlier, but I had $50,000 in expenses, my profit was only 50. And now I have to divide that by the amount of money that it costed me to do the deal. So it seems simple enough, but there's a lot of variables that come in, right? So these are all based off of net numbers. We have to make sure that we just include our rent rolls. We have to include our expenses, get them all together. And once we have final numbers, that is how we are able to determine what our return on investment is. Now, the next thing, let's go and dive into a cash deal, right? So now this is a deal that I bought myself. Well, not personally, this is just a hypothetical situation, but we'll say you paid $100,000 for the property and closing costs were $1,000. So now remodeling costs were about $9,000. So you brought a total to the investment of $110,000, right? My 100K purchase.
Well, you're saying borrowing, but you have cash. This is an example for a cash.
Correct. I bought the property cash. So I bought $100,000 to buy the property, $10,000 in $9,000 in remodeling, $1,000 in closing costs, bringing my total cost to $110,000. I collect $1,000 in rent every single month. 1 year later, right? What did I do? I earned $12,000 in rent, 1,000 times 12. My expenses, including my water bill, property taxes, insurance, came out to about $2,400 for the year, which divided by 12 is $200 per a month. So my annual return was $9,600, which is the $1,200 that I made in rent minus my expenses, right? $12,000 minus my expenses, because I need to know what my profit was, not just how much I collected in rent. What was my profit? And now to calculate the ROI, we're going to divide the annual return, which was $9,600, by the amount of the total investment of $110,000. So on this deal, I made an 8.7% return on my investment by investing $110,000 to make $9,600 per a year. Okay. Now we're going to take the same scenario and now we're going to make it as if we finance the property. So the same $100,000 property. Now my closing, I put down 20% of the purchase price here, which was $20,000, which means that I borrowed 80. My closing costs were a little bit higher because you have a little bit more closing costs when you borrow money. So figure 2,500, and I paid the same 9,000 to remodel the property. So now what was my total out of pocket? I paid $20,000 for my down payment, $2,500 in closing costs, and $9,000 to remodel, which brings me to a total of $31,500. So 70 something thousand dollars less. Now, there are also some ongoing costs that you have with borrowing money, right? So we assume that we took out a 30-year mortgage with a fixed interest rate of 6%. And I remember I borrowed $80,000. So the monthly principal and interest payment on this deal would be $479.64. We'll add the same $200 a month, if you remember, that we had in taxes, insurance, and utilities. So that brings that my monthly payment in expenses to $679.64. I'm collecting the same $1,000 in rent, which is $12,000 a year. And my monthly cash flow is my $1,000 that I'm collecting a month minus the $679 that I'm making payments for in expenses, which brings me to a profit of $320 a month. So now 1 year later, how much did I really make, right? So I made $3,844, which is the $320 times the 12 months, right? Why only 320? Because I had the expenses that I had to pay. Now let's calculate the ROI on this deal, right? Now, sure, the actual, the profits that we made are less. There's no doubt about it because I had higher expenses, but let's see what it does to the ROI and how we could use that to do more deals with the money that we had, right? So now
I just want to, and I'm sorry to interrupt. And folks, keep in mind when you're putting down 20%, like I said before, you're minimizing your risk, you're minimizing, your money. And imagine if you had 100 grand, you're only putting down 20%. So now you could do 5 deals like this and make a greater return on your money. So that 8% or whatever Max is saying can be multiplied into 4 or 5 deals also. Diversify.
Correct. And we're going to break that down right now, right? So now let's look at our annual return that we made on this property, right? So we made $3,844, but how much money did I put to the table this time? I didn't come down with 110,000. I only came down with 31,500. So I'm going to do 3844 divided by 31,500. And my cash on cash return is now 12%, 12.2%, right? So I made about 4 and change percent more on my money financing my deal. Now, why is that important? Because now with the same $30,000 that I put on this deal, I can do 3 deals of this size, right? So now if I'm making 3844 times 3, that's more than I was making on the previous deal, which is going to bring us to about 10,000 and change, which on this one was only 9,600, right? So the goal here is to make your money work for you as much as possible. How can I make the most amount of money with the dollars that I have and diversify that into multiple deals, right? We're talking about a lot of different strategies. The one thing that we have to keep in mind is that if you keep all of your eggs in one basket and one thing goes wrong, there goes everything. But if you have your eggs in multiple baskets and you have 3, 4 different deals going on, and God forbid something happens to one of them, you still have 2 other deals keeping you afloat, working for you, and have equity in those deals that you can work with. So now when you are calculating a return on investment, just a few things that we want to consider. I may have mentioned these earlier, but just to reiterate, the equity, right? What is the market value in the property minus the total loan amount that I have, right? Because I'm building an equity if I'm refinancing out of a hard money deal, and I want to know how much I have in that. Why? Hey, 5 years down the line, 2 years down the line, 20 years down the line, I need more capital to do more deals. I want to buy more cash flow. I want to retire soon. I can now look to my properties to refinance them, collect that equity, and use it for more deals. Repairs and maintenance costs, right? That's something else we want to make sure we understand. You may be collecting $1,000 a month in rent for a year, and that's $12,000. But if you have a sink that needs to be repaired, a clogged toilet, or whatever it may be, these will pull into it. So you don't want to just be paying yourself all the money up front. You want to put that money aside as a safeguard. If, hey, what happens if something does happen? You don't want to be in a situation where you can't handle it and God forbid be a slumlord. Vacancies, right? Not every time are you going to be able to have 100% vacancy 100% of the year. Understand your market. Where are you? Am I in a market where I could fill my property up in 2-3 days, 2-3 weeks, 2-3 months, right? If I have to go 2-3 months without a tenant, can I handle that? Can I make those payments and wait for the tenant to come around? Well, how is it going to affect my return on investment, right? So these are things that we want to make sure we understand. Now, the next thing is financed or mortgage. The less cash paid up front as a down payment on the property, the larger the mortgage loan balance will be, but your greater your return on investment will be, right? So we don't want to go and leverage ourselves too much to a point where the deal doesn't make sense. You won't be able to refinance later, but we want to use leverage to make sure that we are creating the greatest ROI that we can for our property. And the more cash paid up front, the less you borrow, right? The less you have to make payments for, but the lower your ROI is going to be, since your initial cost is going to be drastically higher. So those are really the main key points. This is how you calculate your ROI. We kind of went through the differences on how it changes, whether you finance the deal or whether you purchased it outright. The rest is really up to you, and I'm going to take it back to you, Dad, to go over some of our programs so that we could educate them and tell them more.
Great topic, Max. Great conversation. So what do we do at my company, Express Capital Financing? If everybody looks to the left, Rental 360, that's for the permanent financing on 1 to 4 units, 75,000 up to 2 million. Rates right now 5.25 and above. Minimum credit score 650. Max leverage on a purchase is 75%, and the max on a purchase will be 80%, up to 80, but we can go typically 75% rate and term or cash out. And again, rental 360s for 1 to 4s. The property could be empty. You're coming out of hard money, or you just bought it empty. That's a great thing. Again, banks won't touch that. So, rental 360, our product or program does that because we're a non-bank. The other one is the no doc commercial, which is again the 50,000 to the 15 million. That's what we do for commercial properties. Interest rates, I apologize, it's not 3%. We are going to be somewhere between the 5 to 7%. Credit, like I said before earlier in this webinar, we can go as low as 550. The good thing is we can provide up to high leverage on that. So typically on the no doc, you're going to get 70 to 80% leverage and 50,000 up to 15 million. Closing very quickly. Multifamily, mixed use. This is for bridge or hard money. So I want to be, it doesn't say it over here. I apologize. It's for bridge lending, 85,000 up to 10 million. Interest rates 8% annually. Credit score 680 plus and up to 80% leverage on a multi or mixed use, bridge or hard money. Everyday fix and flips, happy to say it's back. It's the greatest ever. While there's uncertainty, there's opportunity, and millionaires are made in a recession. So for all you investors are getting out there, you're new, you're scared, you're timid, you're learning a lot, especially on this webinar and with Real Estate IQ. Right now is the best time to be fixing and flipping, because even though the property are scarce right now, but there's going to be a multitude of properties coming up. I do want to mention Real Estate IQ, and the reason why. I'm an ex-retailer, and my dad always said, you need inventory. You need inventory. What's inventory in our business? It's leads. Getting leads is going to get you properties. Getting properties is going to make you a landlord. Getting to be a landlord, you're going to be having money, profits, whether you're a flipper or a buy and hold. There is no property in the world that's going to come knocking down your door and say, here, buy me. It's a great property. You're going to make $100,000. You need inventory, and that's a subscription-based, providing you with information such as tax liens, foreclosures, bankruptcies, pre-foreclosures, probates. You need inventory, and that inventory is a subscription based. Some people are leery. I don't want to pay. I don't know how good it's going to be. Hey, you can always cancel, but when you're having a good company like Real Estate IQ, they're giving you that information within 48 hours, I believe, of live leads. And most importantly, they're not only giving you the properties and the information, you're getting a skip trace information, you're getting ARVs, you're getting rental comps. And like I said, there is not a property in the world that's going to come knocking down your door. You need to find them, you need to get them, you need to do your due diligence. And this is the way to grow and create wealth in real estate. So I just want to say that. So Marty, with Martin Chera, I'm sorry.
I'm sorry. I just want to add one thing, by the way, for all the analytics out there, just to add on to what you said. If you're closing 1 out of 20 people, 1 out of 40 people, depending on, what your numbers are in your database, just think about what your total volume would be if you added more leads to that database, right? You already know what your conversion ratios are. Go ahead, add in more leads. You're only going to do more business. The more business you do, the more you're going to grow. The more you grow, I think that's why we're all here.
Yeah. I mean, look, if you're not interested in spending a few $100s a month on a subscription or any type of lead generation, how are you going to make money? You have to spend money to make it, and this is the way to do it. So we're happy to say that, as you know, a lot of non-bank lenders, we're around, we're back, we're happy. It's a secondary market. Why do I say that? It was a very big concern when this COVID happened, but if us non-bank lenders are up and running, that's a very good thing for permanent financing. So how can you reach my company and me and my team? All the information is there. Our main number is 718-285-0806. If you have any questions, please feel free, whether it's about products, programs, anything to do with real estate, we could help you with titles, insurance companies, wholesalers, how to find properties to, to get you to a celebratory closing is what it's all about. So we're not here just to provide you with financing. If you need the tools, the resources, we can help you as well.
Our network is your network.
Exactly. All right, Jeff, it's all yours.
All right, thank you so much, Max and Martin. And as always, very, very great tips. And it's our webinars are always informative. And we thank you for the opportunity to, allow our attendees to learn from you and from your webinars. So let me just share my screen real quick. So for those of you who are, writing down their contact numbers, Max and Martin's contact numbers from the screen a while ago, no worries about that because we'll be
Oh, gosh.
the
What did I
details
do?
in the chat. So let me just post that there. So yeah, so I just posted the links that we will be discussing throughout this webinar before before our Q&A part. So everyone, please make sure to post your questions in the chat box so that Max and Martin can see the questions and answer them before we end the webinar. So right now, in the chat box, you can see the links and contact details that you might need for from Max and Martin. So make sure to copy and paste them to your computers now, so you don't have to, write it down to your pen and paper. So again, this event is brought to you by Real Estate IQ, the number one in deal finding, providing you with more than 45,000 leads every month. And we guarantee that you will always find a deal with Real Estate IQ. So for those of you who are still in the room right now, once you leave the room or once we end the webinar today, you'll be automatically routed to a very, very short survey wherein we will appreciate whatever feedback you will give us, because we will be using this to improve our webinars, if what topics you might be interested at, so we can, find the best speakers for you, so that whatever the topics that you might need for your business, we can definitely find the perfect speakers for you, just like Max and Martin that we have right now. So everyone, we will appreciate your feedback after this webinar. And if you have questions about our services, all you have to do is contact our customer service. So again, if you're not yet a subscriber with Real Estate IQ, it's either you answer our poll right now for the demo request, or you can contact our customer service so that they can give you more information about how our products and our system works. And we guarantee a 2-hour response from our team. And we also have freebies, just like what I told you a while ago, that we are doing raffles every week. So all you have to do is answer this next poll on your screen right now, so that we have an idea if what freebies you might be interested at. So once we draw the raffle, we can select from the freebies that you have selected. And if in any case that you missed the free 45-minute one-on-one deal finding training poll, all you have to do is type in demo please in the chat box, so that I can get your details and make sure to reserve a spot for you for this free 45-minute one-on-one deal finding training. And we also invite you to join our community. So in this community, this works like Facebook. So all you have to do is join in our community at community.realestateIQ.co. So this works like Facebook, so you can connect with other investors, connect with the members of the team or the members of the group, so that you can grow your business. If you're a newbie, this is really a great help for you, so that you can ask for tips, and you might find your business partner in the future in our community. Also, just like what I told you a while ago, you can join, you can reserve your spots for our upcoming webinars. Just go to realestateIQ.co/events so you can be updated of our upcoming webinars. And almost every day, we are updating our website just to make sure that you already have the links for our future webinars. So right now is the perfect time for a question and answer. So for those of you who have questions about Max and Martin or about their topic for today, make sure to let us know in the chat box or the Q&A box so that we can answer them before we end the webinar. And also, if in any case that there's still confusion about their topic or whatever help that you might need in your business, make sure to let Max and Martin know before we end the webinar. So again, the contact details are in the screen and in the chat box. So make sure to just copy and paste them. So in case that you might remember a question by tomorrow or the following day, you can reach out to Max and Martin anytime. So as of now, I cannot see any questions from our chat box or the Q&A box. I guess that you have covered everything clearly, Max and Martin. So, oh, there, I think we have a question from AA. Are you a true non-recourse lender?
So I am a true lender, non-recourse, again, just depends what we're doing, whether it's, bridge financing or actually just bridge financing, because all permanent financing, like I said, is recourse. It is recourse to the entity with warm body carve-outs.
Yep, and she added self-storage.
Yes, that's a commercial property, yes.
All right. So I hope we answered your question, AA. So for those of you, for everyone who's still in the room right now, if you have questions, just make sure to let us know in the chat box or the Q&A box. So before we end the webinar, we will be answering all of your questions. So AA, as a follow-up, what are the terms for self-storage loans?
Are we doing permanent or we're doing bridge?
Yeah, I would recommend that you reach out to us. You can either give us a call or email us, and we'd be happy to share all the different options that we have with you there, and really dig into the deal and make sure it's something you want to move forward with.
Yeah, so for those for everyone, that is also one option that we can give you if ever you have future questions, or if you want to have like an in-depth information about Express Capital Financing. Please do reach out to Max and Martin through their email address or their contact number, so you can call them, or you can go to their website at expresscapitalfinancing.com. So all right. So Martin said that he'll be happy to receive your call. So everyone, make sure to connect with Max and Martin, and also if you have questions with Real Estate IQ, let our team know. So the contact details are in the chat box. So before we end the webinar, I'll be staying in this room for like 2 to 3 minutes, just to give you time to copy and paste all of the details in the chat box so you can save it to your computers. So I think we do not have any other questions from our attendees. So Max and Martin, any final tips or words of advice to our attendees, especially the newbies or the first timers in the industry, of what help that you can provide them? So Max and Martin.
I mean, I'll just add, if you remember that old lotto commercial, you got to be in it to win it. It's the same thing with real estate. You got to be in it to win it. It's a great time to be in it when there's a downtime, a downturn. Some folks, they tell me, oh, I'm doing this course and that course and I'm not ready yet. You're never going to be mindset 100% ready. You just got to be in it to win it. It's just going to happen as you're, getting started along. So that's what I could say there. Anything else you want to add, Max?
Yes, so I'll just add in, a lot of people, I hear it a lot, and I tell this to my team all the time. They're like, yeah, I just want to get lucky. I want a deal to fall in my lap. Unfortunately, luck just doesn't work that way, right? What is the definition of luck? Luck equals opportunity plus preparedness, right? So the more we prepare ourselves, once that opportunity comes around, we'll make sure to grab it, right? So that's what it's all about. Be prepared, get your education, learn as much as you can, put yourself out there so that this way you will find those opportunities, you will be prepared to do it, and you will be a lucky person.
All right. Thank you so much, Max and Martin. And to everyone, just like I'm always saying during our webinars, make sure to save the details, the contact details of our wonderful speakers, especially right now, Max and Martin. So in any case that you're a newbie or you're just, starting with a real estate business, make sure to save their contact details, because, having the contact details of our experts could be your doorway to success. So make sure everyone to be updated with the latest trends with real estate business. Save the contact details of our experts. Attend webinars like this for you to learn and make the most of your time during this pandemic, because opportunities are always by your side. So everyone, thank you so much for attending our webinar for today. For Max and Martin, thank you so much. As always, we are learning a lot from you, and we hope to see you definitely probably next month for our next webinar with you. And everyone, thanks so much for your time. I hope that everyone's doing fine. Everyone stay safe. Have a great evening. Bye for
Thank
now.
you. Thank you, Jeff. Thank you, Real Estate
Thank you,
IQ.
Jeff.
Great work. Great
Thank you,
work.
Real Estate
Thanks,
IQ.
everyone.
Guys, all the best.